Welcome to our channel. If you're new to investing and looking for the best strategies to start building your financial future, you're in the right place. In today's video, we'll break down the top investment strategies for beginners in 2024. Whether you're saving for retirement, a big purchase, or just want to grow your wealth, these tips will help you invest smarter and with confidence. Let's get started. Investing is one of the most effective ways to grow wealth, yet it can seem intimidating for beginners, especially in 2024 when markets and technologies evolve rapidly. Starting with clear strategies, setting goals, and understanding your options is essential for beginners to build a successful investment journey. This guide expands on the best strategies to get started and achieve long-term financial success. 1. Start with clear financial goals. Investment success starts with defining your why. Are you saving for retirement, buying a home, funding your child's education, or simply building long-term wealth? Clear goals help you determine how much to invest, what assets to focus on, and how long you can stay invested. If your goal is retirement 30 years from now, you can afford to take more risks and prioritize growth investments like stocks. On the other hand, if your goal is to buy a home within 5 years, safer, low-risk options like bonds or a high-yield savings account are more appropriate. 2. Build an emergency fund first. Before you start investing, ensure you're financially secure by creating an emergency fund. Life is unpredictable, and unexpected expenses like medical bills or car repairs can derail your finances. Having 3 to 6 months' worth of living expenses in a liquid, easily accessible account, such as a high-yield savings account or money market fund, will act as your safety net. Why is this important? Without an emergency fund, you might be forced to sell your investments prematurely during a downturn, potentially locking in losses. Building this fund first protects your investments and gives you peace of mind. 3. Invest in low-cost index funds and ETFs. Low-cost index funds and exchange-traded funds are beginner-friendly investment vehicles that offer diversification, simplicity, and affordability. These funds track the performance of a market index, such as the S&P 500, which represents the largest companies in the U.S. economy. Instead of picking individual stocks, you invest in a portfolio of companies, reducing the risk associated with relying on one company's performance. 4. Take advantage of tax-advantaged accounts. Tax-advantaged accounts like 401(k) and IRAs, individual retirement accounts, are essential tools for building wealth. Contributions to traditional accounts are often tax-deductible, lowering your taxable income. Roth accounts, on the other hand, allow for tax-free growth and withdrawals in retirement. If your employer offers a 401(k) match, prioritize contributing enough to receive the full match. This is essentially free money. For beginners without access to employer-sponsored plans, IRAs are an excellent alternative. 5. Start small and invest regularly. You don't need a large sum of money to begin investing. Thanks to advancements in technology, platforms like Robinhood, Stash, and Acorns allow you to start with as little as $1. Fractional shares enable you to invest in expensive stocks like Amazon or Tesla by purchasing a portion of a share. Using a strategy called dollar cost averaging, you can invest a fixed amount at regular intervals, such as monthly, regardless of market conditions. 6. Diversify your portfolio. Don't put all your eggs in one basket is a golden rule in investing. Diversification spreads your money across different asset classes, industries, and geographic regions to reduce risk. For example, a diversified portfolio might include U.S. stocks, international stocks, government bonds, and real estate investment trusts. As a beginner, consider starting with balanced funds or target date funds, which automatically adjust the allocation of assets based on your time horizon and risk tolerance. This hands-off approach provides diversification without requiring you to pick individual investments. 7. Understand your risk tolerance. Investing involves risk, and understanding your risk tolerance is crucial for choosing the right assets. Stocks typically offer higher returns over the long term, but are more volatile, while bonds are more stable but provide lower returns. Your risk tolerance depends on factors like age, financial situation, and comfort with market fluctuations. For example, younger investors can afford to take more risks since they have time to recover from market downturns. 8. Explore robo-advisors. For beginners who feel overwhelmed by the complexity of investing, robo-advisors like Betterment, Wealthfront, and SoFi offer an excellent solution. These platforms use algorithms to build and manage diversified portfolios based on your financial goals, time horizon, and risk tolerance. Robo-advisors typically have lower fees than traditional financial advisors, often around 0.25% to 0.5% annually. They also provide features like tax loss harvesting and automatic rebalancing, which help optimize your portfolio's performance. For a hands-off, beginner-friendly experience, robo-advisors are a great starting point. 9. Avoid timing the market. One of the most common mistakes beginners make is trying to time the market, buying low and selling high. Predicting market movements is extremely difficult, even for professional investors. Instead, focus on long-term investing and stay consistent with your strategy. Market volatility is normal, and dips can actually present opportunities to buy quality investments at lower prices. By staying invested and avoiding panic selling, you benefit from the power of compounding. Remember, time in the market is more important than timing the market. 10. Continuously educate yourself. Investing is a lifelong journey, and staying informed is key to success. In 2024, there are countless free resources to help you learn about investing. From online courses on platforms like Coursera and Khan Academy to podcasts, YouTube channels, and books. Start with the basics, such as understanding different asset classes, the importance of diversification, and how compounding works. As you gain confidence, you can explore advanced topics like analyzing stocks, evaluating mutual funds, and understanding market trends. Thanks for tuning in. We hope these beginner investment strategies help you feel more confident as you take your first steps into the world of investing. Remember, the key to success is starting early, staying consistent, and continuing to learn. If you found this video helpful, give it a thumbs up, subscribe to our channel, and hit the notification bell so you don't miss out on future tips and guides. Have any questions or favorite strategies of your own? Drop them in the comments. We love to hear from you. See you in the next video.